The silver price is lying, and the spread is telling the truth, because right now the world can't agree on what an ounce of silver is worth. And by the end of this video, you all know the single pressure gauge to watch to see whether this snaps back in days or breaks wider in weeks. The conflict is already here. The headline price on your screen says silver just did the impossible, punching through $90 for the first time and printing fresh records around the low 92s, and then, almost immediately, getting yanked lower with a fast, ugly drop back toward the high 80s. That's the part everyone sees. The part that matters is what S happening behind it. Different hubs are pricing different levels of urgency. And the global gap is widening at the exact moment it should be getting crushed by arbitrage. And that's where the real pressure starts. Because in a normal market, silver is silver. One metal, one global reference, tiny regional differences that get vacuumed up by traders whose entire job is to clip pennies and close gaps. But in a stressed market, price becomes a question, not an answer. London says one thing, New York says another. Asia's physical bids can lean above or below depending on what's actually available, what can be shipped, what can be financed, what can be refined, what can be delivered on time. And when those disagreements persist, it's not noise, it's the plumbing groaning. But that's not the part most people are watching. They're watching the candle, the big green day, the scary red day, the memes, the hot takes. Meanwhile, the market structure is quietly deciding who gets metal, who gets paper, and who gets squeezed by the calendar. Because if this one mechanism jams, the math changes. Let's put the recent move on the table without turning it into guru theater. This week, silver ran hard into the low $90 zone. Prints around roughly $92 were in play, and then it didn't just drift. It snapped. A sharp pullback pushed it back toward the high 80s and around $89 in a hurry. That's classic silver behavior. Violent momentum, then a gut check. But here's what's different. This isn't just a momentum trade. The macro backdrop is loud. Geopolitical tension, safe haven demand, rate cut expectations, institutional uncertainty, and all of that can absolutely lift precious metals. But the title of this video isn't Silver Rallied. It's Global Price Gap Explodes. That phrase has teeth only when the usual magnet stops working. So let's define the gap the right way. A true silver gap is not just currency conversion, not just Shanghai is in yuan or India has taxes or different dealer premiums. Those are normal frictions. A true gap is when the same metal, adjusted for FX and reasonable costs, trades with an unusually large premium for immediacy and deliverability in one place, while the benchmark in another place stays anchored to paper liquidity. It's the market saying, you can quote me a price, but can you settle me in the right form, in the right location, on the right timeline? And when the answer becomes, it's complicated, you're no longer looking at a simple price chart. You are looking at a supply chain and a balance sheet and a contract spec all colliding at once. Now here is the underappreciated detail and the hidden detail that reframes the entire story. And it's the reason your instincts about free money arbitrage can get you hurt if you don't respect the mechanism. When the global gap widens and stays wide, it's often because the easy arbitrage trade stops being easy. On paper, it's a gift. Buy cheap here, sell expensive there, lock the spread, ship the metal, collect the profit. In reality, that ARB is a stack of constraints. Bar form differences, assay requirements, refining lead times, shipping insurance, customs clearance, available vault capacity, and most importantly, financing and credit lines that can disappear the moment volatility spikes. That's the moment when the spread starts telling the truth. Because the spread is literally the market's way of pricing those frictions. And if those frictions are rising faster than traders can deploy balance sheet to crush them, the gap doesn't close, it widens. But that's not the part that gets headlines. The headline is silver hits $90. The signal is arbitrage is coughing. Here's the cleanest way to understand it without conspiracy brain. Paper versus physical is not a moral argument. It's plumbing. Futures are standardized promises. They're designed to be liquid, to trade at high volume, to allow hedging and speculation and price discovery in one centralized place. Physical metal is the supply chain. Bars, coins, industrial feedstock, vaulting, shipping, refining. Most of the time, these systems stay aligned because a set of professional players, bullion banks, merchants, refiners, industrial users, large traders, connect them. They use spreads, they use exchange for physical mechanisms, they use leases, they use inventory, they move metal when it makes sense. But when the pipes narrow, the blueprint can say one number while the water pressure screams another. And when everyone feels the pressure, behavior changes fast. And that's where the real pressure starts again, because behavior is what drives short-term price, not narratives. Let's walk through the global arbitrage magnet, because once you see the loop, you can see exactly where it breaks. In a normal setup, if Shanghai bids silver at a large premium to London or New York, traders buy in the cheaper market, hedge price risk with futures, finance the position, ship metal to the higher priced market, deliver, and lock the spread. That flow drains the cheap market and feeds the expensive one until the gap closes. It's like water finding its level. But now, inject today's conditions. Volatility is high, which increases margin requirements and risk limits. Financing becomes expensive or scarce. Shipping and insurance cost more when markets are stressed. Refining and conversion timelines matter because an ounce isn't always the same deliverable bar in each hub. And if policy or trade rules restrict exports or complicate licenses, the loop gets slower and riskier. Suddenly, the RB isn't free money. It's a multi-week exposure to basis risk and operational risk, and that's when the gap can persist long enough to become a story. But that's not the part most people understand. They see premium and assume manipulation. The reality is more brutal. Constraints create premiums. The market is paying to solve a problem. Now we shift shape for a moment, quick calculation, because it snaps your brain into mechanism mode. If one region is effectively paying, say, an $8 premium per ounce when silver is around $90, that's close to a 9% premium for location and immediacy. That's not a cute little dealer markup. That's a message. It says either demand is urgent, supply is constrained, financing is tight, or all three. And if you're thinking, okay, then arbitrage should fix it, you're halfway there. The other half is arbitrage requires balance sheet and time. And those are exactly the things that get rationed during volatility. Because if this one level breaks, the math changes. Now zoom in on market structure, because this is where the real evidence lives. Term structure and spreads. Silver doesn't just have a price, it has a curve. Different prices for different delivery months. In calm conditions, silver often carries in contango. Later months, slightly higher than spot, reflecting storage, insurance, financing, and the cost of carry. When markets get tight, you can see backwardation or signs of it, the market paying up for near-term delivery relative to later delivery. That is urgency pricing. That is the curve telling you, now is scarce. And when the curve starts screaming, participants are forced to act. Traders who normally roll positions smoothly start paying attention to which month is expensive, which is cheap, and whether rolling is costing them more than expected. Merchants and industrial users start asking whether they should secure supply earlier. And shorts, especially leveraged shorts, start feeling time pressure because being short nearby in a tight market is not the same as being short somewhere out the curve. But that's not the part that gets clipped into a tweet. The curve is boring until it isn't. And when it isn't, it moves price. Now let's talk inventory, because inventory is always the battleground in a delivery market. And silver's inventory story is a story of categories, not just totals. Headlines will tell you inventories rose or inventories fell. But the critical distinction is what is actually deliverable versus what is merely sitting somewhere with an owner who may not be willing to part with it at that price. In exchange-linked systems, you have inventory that S registered for delivery and inventory that S eligible but not committed. That difference matters when delivery pressure hits, because when the market gets stressed, eligible metal doesn't magically become deliverable just because a spreadsheet says it exists. Someone has to choose to make it available, and when premiums are rising elsewhere, those choices change. You can't evaluate a gap story without respecting deliverability, that OESY gaps can widen in the first place, because what the paper market references is not always what the physical market can source on the timeline that matters. And that timeline is the calendar. Hold that thought. We're going there next. But first, we need to address the chart, without turning it into superstition. Silver just showed you a blow-off attempt and a violent rejection. That sequence matters, because it tells you two things at once. There is real demand strong enough to force a historic print. And there is liquidity thin enough that the same market can drop several dollars in a short window when profit-taking or de-risking hits. So here's the practical framing for right now, this week. The recent high zone, call it roughly the 91 to 92 area, becomes the psychological ceiling that bulls want to reclaim quickly. The $90 handle becomes the battlefield, because round numbers in silver act like magnets and traps. Then you have the first meaningful support band in the high 80s, think roughly 88 to 89, where dip buyers will try to prove this move is a trend, not a spike. And below that, the mid-80s become the line that separates controlled pullback and retest from deleveraging wave. Those aren't magic numbers, they're behavior zones. They tell you where forced buyers might show up, where hedgers might adjust, where margin calls might accelerate. Because if this one level breaks, the math changes. Now we shift shape again. Let us talk positioning and margin spirals, because this is where silver becomes different from most assets. Silver is small relative to other global markets. It's liquid, but it's not infinitely liquid. And it carries leverage like a live wire. Futures allow large notional exposure with a fraction of capital, and when price swings expand, margin requirements can rise, risk limits tighten, and positions that were fine at $80 become a problem at $90 with a 3% down day. Here's the mechanic. When volatility increases, clearinghouses and brokers can require more margin. That forces participants to add cash or reduce positions. If someone can't add cash, they reduce. Reductions are sales. Sales move price down. Price down increases stress for other leveraged holders. That can cascade. And it can happen even if the fundamental story is bullish, because forced selling doesn't care about your thesis. It cares about your margin. Now flip the lens. Shorts. If you're short and price rips higher, you face increasing losses and rising margin. Some shorts cover because risk mandates it. Covering is buying. Buying in a thin tape accelerates the move. That's how silver can overshoot. That's why it can also snap back. It's reflexive. And that's why the psychology game matters. But before we go there, we need on-the-ground symptoms. Because you can call this, something is breaking, unless the street is behaving differently than the screen. The first symptom is premiums and availability. Not the most viral premium screenshot you can find. Real signals. Dealers widening buy-sell spreads, longer delivery times, wholesalers allocating product, industrial buyers quietly locking supply, and regional premiums staying elevated even when the screen price pulls back. That last part is important. If price drops 3 and physical premiums done relax, or they relax less than you might expect, that asks the market whispering, this isn't just speculation. The second symptom is spreads between venues, basis behavior, when London versus futures pricing doesn't converge smoothly. The third symptom is what large pools of money do. Because if institutional flows are leaning into this, they do it in vehicles like ETFs and derivatives. The knock-on effects can be real. In many structures, ETF creations and redemptions can translate investor demand into physical acquisition or release, depending on the vehicle. When investor demand surges, it can pull on the physical supply chain indirectly. When redemptions hit, it can release supply. But here's the key. Even when flows matter, they don't operate in a vacuum. Authorized participants need to source, finance, and move metal. In tight conditions, that process can become more expensive and slower, which feeds back into premiums and spreads. And that's where the real pressure starts again, because it becomes self-reinforcing. Stress widens spreads, wider spreads attract attention draws flows, flows pull on supply tightens, spreads widen. Reflexivity. Now let's bring in macro, because yes, silver is a metal, but in moments like this, it behaves like a macro asset too. When rate cut expectations grow, non-yielding assets become more competitive. When the dollar wobbles, metals can benefit. When geopolitics intensify, hard assets get bid as insurance. And in the last few days, the macro narrative has been loud. Safe haven demand, policy uncertainty, geopolitics, and the kind of institutional tension that makes capital want refuge. That helps explain why silver can surge alongside other metals. But don't let macro become the entire explanation. Macro can light the match. Market structure decides how big the fire gets, because the market can price a narrative in seconds. It can't manufacture deliverable inventory in seconds. Now we hit the calendar, the why now trigger, because this is the most underappreciated accelerator. Delivery windows, roll periods, option expiries, month-end and quarter-end balance sheet constraints, thin liquidity sessions around holidays or during risk-off waves. These are not trivia. These are the geometry of liquidity. In certain calendar windows, the marginal participant steps back, spreads widen, and small imbalances become big moves. If you have a delivery month where people suddenly care about near-term metal, or a roll window where large positions shift exposure from one contract month to another, that flow can pressure the curve, and the nearby month specifically. If you have month-end or reporting constraints, balance sheet gets rationed right when arbitrage needs it most. That's how you can get a global gap that doesn't immediately get crushed. And once it's visible, it changes behavior. Industrial buyers think, do we wait and risk higher premiums? Funds think, do we chase or do we reduce risk? Dealers think, do we widen spreads to protect ourselves? Everyone is managing their own risk in real time, and the combined result looks like chaos. But it's not chaos, it's forced decision-making. And that's where the real pressure starts. Now we pattern interrupt again. Instead of narrative, you get a checklist, because this is how you protect yourself from hype while still respecting the signal. If you want this to be evidence-driven, you don't need one argument. You need a stack. Here are the proof points that matter, and you can watch them without needing to worship any single guru. 1. The global premium, or basis behavior. Does the gap between regions stay wide even when price pulls back, or does it collapse instantly? Persistent gaps imply friction. 2. The curve. Does near-term pricing stay firm relative to later months hinting at urgency, or does the curve relax into normal carry? 3, deliverable inventory focus. Are there signs? The deliverable category is tight relative to demand, even if total inventory looks fine. 4, spread behavior and exchange for physical dynamics. Are there episodes where the futures to spot relationship becomes jumpy, implying stress and converting paper exposure into physical settlement? 5, street level symptoms, premiums, delivery times, and dealer spreads. If the street stays tight while the screen whips, that's a tell. 6, institutional behavior. Do flows continue to show demand for exposure even after a sharp pullback, or does the pullback trigger broad de-risking? 7, chart structure. Does silver reclaim the big round number quickly and hold, or does it chop lower and fail retests? Any one of these can lie to you in isolation. Together, they form a picture, but that's not the part most people do. Most people pick one metric, fall in love with it, and then get emotionally hijacked by the next candle. Which brings us to the counterpoints, because credibility lives in knowing what would diffuse this. Silver can look broken and then normalize fast. How? Liquidity returns, volatility compresses, financing eases, arbitrage capacity comes back. Premiums collapse because supply arrives or demand cools. A sharp margin increase forces liquidation that temporarily overwhelms physical tightness. Geopolitical stress cools and safe haven bids fade. Any of these can pull pressure out of the system. And you need an invalidation level, not because you're predicting doom, but because you're managing risk. If silver can hold the high 80s on a closing basis and starts living back in the mid 80s with weak rebounds, that increases the probability you're looking at a deleveraging wave rather than a healthy retest. Conversely, if silver reclaims $90 and starts holding it again while premiums and spreads refuse to relax, that's not just a bounce. That's stress persisting. And if the recent highs around $91 to $92 get reclaimed cleanly, the continuation scenario becomes much more plausible, because that's almost the point where trapped shorts and late sellers start getting squeezed by time again. But that's not the part that matters most for you as a viewer. The part that matters is how volatility will try to steal your decision-making. Silver's favorite trick is to make smart people chase strength and puke weakness. It spikes. You feel late, you buy high. It dumps, you feel stupid, you sell low. Then it rips again. And you're left with a story about manipulation when the real culprit was lack of a rule set. So here's the psychology shield, and it S non-negotiable if you want to survive this kind of tape. Separate trend signal from noise. A trend signal is structure. Higher highs and higher lows that holds through pullbacks, premiums that stay firm, a curve that hints at urgency, gaps that don't instantly close. Noise is the intraday whip, the headline, the emotional impulse to do something. Decide in advance what would make you act, not what makes you feel. Use levels as behavior zones, not prophecy. If you're adding exposure, understand your horizon. A one-week thesis is not the same as a one-year thesis. And never pretend volatility can't hurt you just because you feel right. Price can whip around violently even if the thesis is correct. That's the point. Silver is a market where being right and being early can look identical to being wrong. So risk management isn't an accessory, it's the entire game. And that is where the real pressure starts, inside your own decision-making, because the market will test your patience before it pays you for being correct. Now we come to what happens next, and I'm going to do this the only way that preserves credibility. 2 scenarios with clear tells, and a near-term roadmap you can actually use this week and next week. Scenario 1 is the controlled pullback and retest. In this scenario, silver digests the historic move, it chops, it scares people. It maybe dips into the high 80s, finds bids, and starts building a base. Premiums and spreads cool slightly but do not collapse. The curve relaxes but doesn't invert into a comfortable carry that screams no urgency. The key tell is stabilization. Pullbacks get bought, rebounds hold, and $90 becomes a ceiling that is repeatedly tested until it becomes a floor. In this scenario, the market is converting excitement into structure. It's not over. It's maturing. What confirms it? Higher lows forming above that first support band, and a gradual reclaim of $90 that doesn't instantly fail. What weakens it? Repeated failures at $90 with worsening downside momentum and shrinking bid depth. Scenario 2 is the continuation, squeeze, and gap risk scenario. In this scenario, the pullback was a reset, not a top. The global gap stays stubborn. Physical premiums remain elevated. Arbitrage capacity stays constrained. And any reclaim of $90 turns into forced buying because participants realize the market isn't T giving them time. In this scenario, silver can gap, especially in thin liquidity windows. It can jump multiple dollars faster than your brain can process. What confirms it? A clean reclaim of $90 that holds, followed by a push back into $91 to $92 with increasing urgency, meaning dips get shallow and bought quickly. What invalidates it? A failure to reclaim $90 paired with a breakdown through the high 80s that accelerates into mid 80s and stays there, that would suggest deleveraging is dominating and the market needs a deeper reset before it can launch again. Now, here's the one metric I promised you at the start, the single pressure gauge that tells you whether something is breaking, is real, or just cinematic language. Watch whether the global premium and basis stress persists through weakness. Not on the day silver rips. Everyone notices that. Watch it when silver drops. If the screen price falls and the real-world price signals, premiums, spreads, availability, urgency, and nearby pricing refuse to relax in proportion, that's a sign the problem isn't sentiment. It's supply chain and balance sheet friction. And that's the part mainstream coverage misses, because mainstream loves a single number. Markets are never one number. They are a set of constraints negotiating in real time. Now, what do you do with that information without turning it into reckless advice? You respect it as a map. If you're a macro watcher, you track whether safe haven drivers remain in force and whether volatility is expanding. If you're a metals person, you track premiums, delivery timelines, and the curve. If you're a trader, you stop letting the candle hypnotize you and you anchor on behavior zones. Does 90 hold or fail? Do the high 80s defend? Does a reclaim of the low 92s trigger a squeeze? And no matter who you are, you plan around the reality that silver can slap you even when you're right. That means position sizing that lets you survive a 5% day without panicking. That means not confusing leverage with conviction. That means being willing to say, my thesis is intact, but my entry timing was wrong, and not turning that into a personality crisis, because the market will try to emotionally manipulate you with volatility. It will show you green and make you greedy. It will show you red and make you ashamed. It will show you chop and make you bored. And then it will move when you're least prepared. Your edge is not prediction. Your edge is preparation. And that's where the real pressure starts, on the people who refuse to prepare. If you've stayed with me this far, you're already in the tiny minority that watches structure instead of headlines, that wants mechanisms instead of slogans, and that's the kind of crowd that doesn't get farmed by volatility. Keep doing that. Track the gap, track the curve, track the deliverability stress. And this week, don't let the market bully you into a decision you didn't plan for. Because if silver is truly in a regime where the world can't agree on price, the next move won't be polite. It will be fast, it will be emotional, and it will punish anyone who's reacting instead of measuring. And if you want to be part of a community that measures first and reacts last, you know what to do. Stay close, stay sharp, and keep your eyes on the spreads, not the noise.